Hello traders, Gary Wagner here, just about 12:30 in Honolulu, 5:30 in New York. It is Fed Day, December the 11th, 2019, and this is the Daily Report for Gold and Silver. We did see the Federal Reserve speak today, and more importantly, release their dot plot, which indicated how voting members would look at not only 2020, but 2021 and 2022. We will go through that in detail in our opening letter, and we also will include the actual dot plot from the Federal Reserve, the graph, so that you can take a look at it. But we did see the precious metals move higher. We saw the equities market react in a positive manner, and we saw dollar weakness as an end result. On today's report, I not only want to go over our current trade, but take a look at a super cycle model vis-a-vis Elliott Wave, and that is going to kind of overlay the shorter term major count that we have been looking at. First, let's take a look at our current pricing. As you can see, information released by the Federal Reserve was moderate to strongly bullish today in terms of gold pricing. Gold currently up about $11.20, with February's contract at $14.7930. It's a net change of about 0.75%. Now, silver gained about 1 1/3%, still below 1,700 at 1692, but nonetheless a fairly impressive move in the market today. Now, we had platinum up over 2% on the day. That's another strong gain. If you look at this daily chart to the left of you, you will see we have had an extremely strong move over the last couple of days, taking the price of platinum from $890 to its current fix at $942. But it is palladium that is most impressive in terms of its moves, its daily moves. And as you can see by these green candles, this market has been just on a tear, currently at $1887, just a few dollars shy of $1,900 per ounce. Let's take a look at our technical studies, discuss our current trade, as long as a first peek at our Outlook 2020, which will include a super cycle in gold vis-a-vis Elliott Wave. The first chart we're going to look at on today's show is a daily candlestick chart of February gold futures. We've included an Elliott Wave count, along with a retracement showing us where the correction that did end should have ended, and our current moving averages, the green being the 50-day and the blue being the 100-day moving average. The first thing in terms of short-term resistance that we're looking at, we still have to focus on the 50-day moving average, because it really seems as though the market has kind of been following the 50-day moving average as the current level of resistance. We can see that right here. We had tops that came in not only today, but at the end of last week that conveyed that. Now, since the beginning of this week, this being only Wednesday, we've had 3 green candles, although the Monday and Tuesday's candle showed slight gains, and then a nice gain today. We did see the highs fall right at that 50-day moving average. And so that's the first level of support we have to conquer. And as we've talked about before, above that is 97 to 1,500, and then above that is about $1,520. In terms of major support, we can definitely see that the likelihood that the correction we witnessed from when the market hit its high of the year and the first time it traded above 1370 since the market correction ended back at the beginning of 2016 at 1565. So we can certainly make a case right now that we are in a wave 5 move up. In terms of where we're looking at for that wave to conclude, we're looking at 1625 as a potential, but realize, as we've talked about, this wave is still going to contain a subcount, which should be a series of 5 waves, 3 being impulse waves going in the prevalent trend direction, of course, which is currently up, and 2 counter waves or corrective waves that will move the market lower. I believe that we are still deeply in the first part of the fifth wave. But on today's show, I do want to take a look at a much larger model that we have derived by using a monthly chart and a very, very long-term Elliott wave count. Let's go ahead and pull that up. And as I work on my 2020 outlook, I wanted to take a look at not the major count, but the super cycle count that rests above that. And you can see some major differences, because what this is detailing is that the long move from about $300 all the way up to this top at about 1920 was a super cycle third wave. And that, of course, really determined where we were looking at the correction to go, because we know that the market fell down to these lows at 1040, and this is when this multi-year correction concluded, which of course is the end of 2015 and the beginning of 2016. That being said, what we are looking at is the moves we have seen over 16, 17, 18, and 19 have been part of a super cycle fifth wave. And if we take a Fibonacci extension of wave 3 and then plot where we would get a fifth wave conclusion, that takes us up to almost $2,100. Of course, I'm not looking for that so much in 2020, but I do believe that there is the potential to see that by 2021 at 2022. But it is showing us that this bull run that began a few years ago still has a lot of steam ahead of it. My recommendation on our current trade, of course, is to maintain our position, maintain our stop. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.